Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the S&P 500 that, after dipping briefly into bear market territory at 24% off the all-time high, we saw the market rebound here from the low, quick 8%. This just highlights the type of market environment that we're currently in. It's extreme volatility, extreme swings up and down. 8% is around the annual average return of the S&P 500. So these are really just astounding, massive moves, both to the upside and to the downside. Although in this first half of 2022, we've definitely seen more downside than upside. Now here on the 17th of June, we actually printed a very rare reading here that we've really only encountered a handful of times in the past 20 years. It happened once during COVID near the low. Let me put up the S&P 500 on this chart. The market triggered a very rare oversold reading on this indicator with less than 1% of stocks at the low here trending above their 50-day moving average. So pretty much all stocks were trending down here at this moment. We did cover this last week, and the fact that this type of oversold nature of the market is only encountered near local bottoms. Right, for example, during COVID, you had that reading here on the 12th of March. The bottom was on the 23rd of March, so you did have a little bit more downside. In 2018, you had one right at the low, moved back a little bit further. In 2011 here, you had one reading at near the low, and then the market proceeded to form a bottom, which was an ideal accumulation entry. Then in 2008, let me put this on a black line here so you can see that clearly. You had that reading right after the big collapse in October 2008, and you had that reading right here. Now you did see an additional move down from around 900 points on the S&P all the way down to around 700 points on the S&P. So another big move down after that reading. But it does give you an idea of the risk reward that we had right here on the 17th of June, 2022. So not surprising to have seen a quick snapback around 7 to 8% on the S&P. Now, of course, there's still lots of work to do from a technical standpoint for this downtrend to turn into an uptrend. But a general rule is that a bottom always looks bad when it's made. So in this video, we are going to see what kind of signals we're getting here that are similar or different to what we've seen in these previous bear market rallies throughout 2022. Of course, we're seeing this as consumer sentiment is at lows that we saw in 2008, lows that very often correspond to recession periods. You really do have consumer sentiment at the same levels as what we see during typical recessions. At the same time, as we posted on our Twitter, we're seeing a record number of small traders bet against the market here, not at levels not seen since the pandemic that obviously triggered a major bottom in the market, and the global financial crisis at the very bottom of the global financial crisis, just showing you the extreme type of market environment we're currently in. If you're interested in following these crazy markets with us, make sure to smash that subscribe button. Don't forget to click on that like button if you enjoy this episode, if you appreciate the time and effort that goes into making these videos. And now, without further ado, let's get right into it. Now, before we dive into that, I do have a quick announcement to make. We are officially reopening the trading room on our website. The trading room is the most optimal way for you to be in contact with me and the rest of the Game of Trades team. We're on the trading room throughout the entire trading day, answering any questions you might have about the market, questions about technical analysis, questions about macro, what's going on in the market. And it's also a great place for you to share your own ideas, whether that's from a trading standpoint or an investment standpoint, and hear feedback from the team and the rest of the Game of Trades community. You can make chart requests and generally engage in a discussion that is extremely enriching with a lot of very smart investors. So if you are interested in that kind of service, make sure to join and test out the service by clicking on the link down below. Okay, so the first thing that I want to talk about is the advanced decline line. The advanced decline is a very important indicator. It takes the number of advancing stocks minus the number of declining stocks. And it's just a huge indication to what's going on underneath the surface in the market. So this is the S&P 500 in black and the NYSE advanced decline line in blue. And you can see, and I'll just start off by quickly giving you two examples here. You can see at the top here, in 2021, the market had made a higher high in January, in December 2021, while the advanced decline line made a lower high, a clear lower high, telling you that a lot of stocks were starting to roll over already, despite the market continuing higher. And you can see what's going on here in 2022. For the first time in this correction, we're starting to see the advanced decline line move higher despite the market making a lower low. And so let me jump on a chart just to show you a few more examples here. This is the advanced decline line that I've put on this chart of the S&P 500. You can see this divergence very clearly, lower low on the S&P 500, while the advanced decline line is telling you some of the stocks are already rallying before the bottom on the S&P 500. This is that big top right here in 2022. Big divergence between the S&P and the advanced decline. If we move back a little bit further, this was a big divergence here in 2020 as the market was rallying in a parabolic move and the advanced decline line was moving down. That triggered a nice multi-month period of consolidation. Then let's go even further back. In 2018, this top here was preceded by divergence with the advanced decline line. Again, advanced decline lines works as an indicator for both tops and bottoms. If we go back further here, in 2015, higher highs on the market, lower highs on advanced decline, triggered a multi-month period of consolidation. Let's go back even further. In 2011 here, the advanced decline line bottomed in August 2011, but the stock market bottomed in October 2011. So you had divergence build throughout this bottoming process, right? And that's something that could happen today, right? This is a bottoming process where the markets go sideways for multiple weeks before eventually really finding a footing. And of course, I had to highlight the 2008 top here, where you had a big higher high in the market and the advanced decline line just collapsing right here, making a lower high, telling you that the market wasn't ready to continue the bull run. And you can see that's very different to what typically happens in a bull run, where you have higher highs in the market and the advanced decline line confirms that. That's a big difference, right? You can see the change in character here. Now notice something else right here. The advanced decline line did not make any divergence throughout the bear market. No divergence. Every low in the market was also a lower low on the advanced decline line. Every time. That really told you that there was a general, broad, and relentless pessimism across the market, across all stocks, that was bringing down the index. So again, lower low on advanced decline. No divergence anywhere to be seen here. So this is not a 100% indicator. No indicator is 100%, but this is definitely something interesting to observe, something we haven't seen until now. Can we see these divergences get burned through and see the advanced decline line collapse? That's very possible. This is one additional piece to the puzzle. Another interesting development we're getting here, if we take a look at the MACD, we recently had a bullish crossover here, telling you momentum is flipping bullish in the short term on this daily chart. And that's following divergence between the price and the MACD, right? So you can see here, lower low on the price, higher low on the MACD. This is the same thing we got right here at the bottom in March. Right here, lower low in the price, higher low on the MACD, and that was followed by a nice breakout. And you could argue this is an impulsive rally, right? And definitely broke a lot of the moves down we saw here. So that's technically a bullish setup. Now, personally, I don't think this is a buying opportunity here. The buying opportunity was when the market was oversold right here. Clearly you want to stay away from buying the market when it's up 8%, right? It's overbought. This has clearly been a failing strategy throughout 2022. You want to be focused on those opportunities where the market is very oversold and positioning for that next big leg higher, because we do still want to see the breadth, the long-term breadth. This time it's the number of stocks above their 200-day moving average. We want to see that improve drastically before considering any type of exit or bearish tone. I think we want to see this breadth here really improve, and this is something that we saw even in the bull trap in 2008. So if you think we're currently in that position, it's similar to that 2008 bull trap here, and you're looking for an exit, typically you want to be doing that when the breadth has recovered and is more overbought than when it's very oversold. Because with the market so oversold like this, it's an extremely poor risk reward, right? Currently we have the VIX at support here, or near support, coming down to this trend line that has acted as support a few times. This typically marks big tops in the market, right? Let me just show you that by putting the SP 500 on top. You can see every time the VIX tags support, it marks a nice peak in the market, right? So you don't want to be positioning when the VIX is coming down to support. You want to be positioning when it's at resistance. In fact, if we do the same exercise for those spikes to resistance, these were all great oversold readings to position long into. Now, I think if there is another buying opportunity, it won't come on a test of this resistance line. That would come on a breakout of this type of consolidation pattern we've been in, and we tag the 46 to 50 range on the VIX. So if this bullish setup that we're seeing fails and we do have additional bad news creating one final capitulation event on the market, we'd expect the VIX to spike, and that typically corresponds to a massive buying opportunity in the market. So that would be that final long entry that we'd be looking for on the S&P 500. That could look something like what we saw in 2018, right? And let me just show you this capitulation move down in 2018. You had the VIX lower highs here, and then the VIX broke out and got to pretty high levels. If we saw that same capitulation move on the VIX, let me just copy that and move it over to where we currently are. That could take us to around 46 to 50. And historically, if we jump on the weekly chart, that's coincided with the most attractive opportunities for buying the dip on the S&P 500. You just don't get better opportunities than that. 1998, 2002, 2010, 2011, 2015, 2018. The only two moments where that wasn't a massive opportunity was October 2008, where the market still continued lower, and COVID-19, where you had the initial spike in February, but the market still continued, I believe, another 20% down before bottoming. So that's, of course, something to keep in mind too. But in general, this yields massive risk reward. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.